It was never a question of if, but when the stock market would finally relent to the realities of policy normalization. While it's true the initiation of the normalization process only seemed to fuel additional demand for record high stocks through 2017 and right up to the other week, these moves were more a function of an attempt to get it all in before the party came to a screeching halt. It's also important to note that normalization up until now hasn't been enough to force investors to reconsider investments with rates still seen as exceptionally low. But now that we're close to normal, the idea of a world where there is no longer the same stimulus there was a decade ago with monetary policy in a place where it could even have increasing pressure to need to be thinking about higher rates if something like inflation jumps back into the picture, everything gets a lot scarier for investors who might finally have a difficult time reconciling their equity exposure. A profit is never a profit until realized, and it looks like the market is realizing this right now. None of this is to say that this is the top and we won't see another buying of the dip like so many times before. But at the same time, we believe a massive correction in the US equity market and global equities by extension is justified after the market was artificially inflated to current levels, which means we believe the US equity market should go through an extended period of weakness as this overdue rotation from stocks plays out. The currency market reaction, however, is a lot less clear in our view. This is because of the state of the US dollar in a world where the US administration is aggressively pushing an agenda where it is directing the dollar lower to help rebalance the US economy. It's also because the market has been buying dollars in the second and third quarter of this year on the back of Fed hawkishness that may need to be reined in as the stock market falls off. But this time, we don't see stocks getting so excited about racing back to record highs because the Fed has taken a step back. From here, there is no grand plan towards a massive accommodation that would get investors excited like it once did. That ship has sailed. What this all means from the currency side is that we may end up seeing a scenario where the dollar is sold aggressively against the major currencies, with these currencies used as safe haven alternatives to the US dollar, but perhaps the dollar holds steady or outperforms risk correlated currencies that are pressured from the broad deterioration in sentiment. We see the yen and Swiss franc continuing to battle unwanted appreciation, which leaves the euro and pound as primary candidates to absorb a lot of the flow. Interestingly, if that Brexit deal gets done, the pound may stand to appreciate the most in a world where investors are looking for deeply liquid currencies that aren't in the business of wanting to trade lower on account of trade. The UK economy has operated with a strong currency historically, and this could come back into play in a big way because of where we're at. Overall, none of what's happening should come as a shock to anyone. The shock is perhaps more about how the stock market was able to hold up for so long without seeing any capitulation. So it needs to play out, will play out, and all of this should be viewed as a part of the process that gets the global economy back to where it needs to be after a crisis that began a decade ago. That's all for now.